All right, welcome to The Explainer. Today we're diving into something that's, well, a real head-scratcher in the market. It's the story of Gartner, a top IT research firm that seems to be living a paradox. You've got a company whose stock seems to be in a total freefall, but at the same time, its business is hitting record highs. How does that even happen? So let's try and unpack this mystery. Okay, so to really get what's going on, you have to rewind a bit. Earlier in 2025, Gartner's stock was just soaring, right? It hit this incredible record high of $579 a share. But then you fast forward to today, and whoa, the picture is completely different. The stock is now trading way down around $232. I mean, that is a massive drop. We're talking a 60% plunge from its peak. Now, usually when you see a drop like that, you'd think, oh, this company must be in some serious trouble. But is that what's actually going on here? Okay, before we go any further, just a quick but important reminder. This is not financial advice. Everything we're talking about here is for educational purposes, so please always do your own research before making any investment decisions. All right, let's get into it, because this is where the story takes a really interesting turn. You know, when you start to look past that scary stock chart and dig into how the company is actually doing, a totally different narrative pops up. And here it is. This is the heart of the paradox. On one side of the coin, you've got the stock, down a whopping 60%. But then you look at the business itself, and what do you see? Revenue is up 5.5%, and their adjusted earnings per share, which is just a key way to measure how profitable they are, that's up 9%. So you've got to be asking yourself, how is that even possible? And look, this isn't just some lucky one-time thing. Gartner is a fundamentally solid company. Check out its net profit margin, a really strong 19%. Let me put that in simple terms for you. For every $100 that comes in, a full $19 of it is pure profit. That is a seriously profitable business. And it gets better. The company isn't just growing, it's also blowing past what Wall Street expected. For its second quarter, both its revenue and those adjusted earnings per share, they were higher than all the analysts predicted. So the mystery just gets deeper, right? A profitable, growing company that's beating expectations, and yet the stock is just getting crushed. So if the company itself is doing this well, what on earth is causing this disconnect? There have to be some outside forces at play here. And yeah, that's exactly what you find when you start looking at the headwinds Gartner is flying into. Now, the really crucial thing to understand is that these are external problems. It's not something broken inside the company. First off, CEO confidence across the whole economy is a bit shaky, which means companies are pulling back on their spending, and that includes services like Gartner's. Second, they're dealing with some delays in U.S. federal contracts because of new efficiency policies. So yeah, these things are slowing down growth for sure, but they don't signal some deep, fundamental flaw in how Gartner does business. Okay, so faced with these challenges, is Gartner just sitting around and waiting for things to get better? No way. They're actively steering the ship toward what they see as a massive opportunity, one they believe will be their next huge growth engine. And you guessed it, it's artificial intelligence. Their plan for AI is actually pretty simple, but it's also really powerful. First, they're using their trusted name to become the go-to guide for clients trying to navigate this super complex world of AI. Second, they've launched this new tool called AskGartner, which is an AI-powered platform to get insights out faster. And what's the end game? Well, they want to use AI as the spark to get back to that awesome double-digit growth. So talk is cheap, right? How is management actually backing this strategy up? Well, they're putting some seriously confident numbers and actions behind their words. This is basically their roadmap to get back on track. And here's what's really telling. Even with all those headwinds we just talked about, management actually raised its earnings forecast for the whole year. They're now expecting revenue over $6.4 billion and adjusted earnings per share of at least $11.70. You know, raising your guidance when times are tough, that is a huge vote of confidence in your own business. And they are absolutely putting their money where their mouth is. The company has already dropped $725 million just this year buying back its own stock. Now, when a company does that, it's a pretty strong signal that the people in charge think their own shares are on sale, that they're undervalued. It's like a direct investment in their own comeback story.
This timeline here really lays out their game plan. They're upfront about the challenges this year, in 2025, but they see a clear path back to high single-digit growth next year, in 2026, and then a full-on return to their historical pace of double-digit growth by 2027.
So, what's the big takeaway here? Well, the source material we looked at seems to suggest that for someone thinking long-term, this big gap between the stock price and the business itself could be an opportunity. The analysis frames it as a reasonable long-term play. And that brings us to the final and most critical question. We've seen the paradox, right? Strong company, weak stock. We've seen the why, those external headwinds. And we've seen their big plan, betting on AI. So the question we're all left with is this. Is Gartner's huge bet on AI going to be enough to win over the market and finally close that gap between its performance and its price? I guess only time will tell. And that's our explainer for today. Hey, if you found this breakdown useful, it would mean a lot if you'd hit that like button and subscribe to support more of these. We'll see you in the next one.